welcome everyone to the Wealth Creation Through Real Estate webinar series. Tonight we have a special guest, CoStar's Andrew Rybczynski, who's going to update us on the economy. My name is Gary Lipsky and our co-host is Kyle Mitchell. A little bit about me. I'm a multifamily investor and syndicator in over 1,700 apartment units. I have $17 million assets under management with my co-host Kyle Mitchell. I host several meetups and I'm the co-host of the podcast Asset Management Fridays with Kyle. Been a lifelong entrepreneur my whole life, 30 years of operational experience. I co-produced some independent films in my 20s, started investing in real estate 2002, and I'm a founder of a nonprofit organization called Core Educational Services. A little bit about Kyle. He also runs the Monday podcast, Passive Income Through Multifamily Real Estate. So our Friday podcast is under this one. And if you haven't listened to it, definitely check it out, like and subscribe. We give a lot of great content on a weekly basis. Kyle's also a meetup host and has years and years of operational management experience as well. He actually used to work for a golf course, and his claim to fame was a 2014 national championship in Rose Bowl games, where they served and hosted over 40,000 people in 2 days. So I don't know how he did it, but he pulled it off. Pretty remarkable. You can see some pictures on the left-hand side. So Kyle and I, we had two separate companies, and we have recently formed APT Capital Group. And our mission statement is to positively impact the lives of our investors and the communities in which we invest through the highest level of transparency and fiduciary responsibility. Our values are Kaizen, which means a gradual improvement every single day, every single year, constant improvement. First class communication and people first. So we're finishing up the website, but you will be able to check it out hopefully by the end of the week at aptcapitalgroup.com. And I'd also like to bring on our special guest tonight. We're excited to have him. So Andrew's been working for CoStar and makes recommendations on investment in commercial real estate. Andrew frequently speaks and writes on the multifamily property type and has been published in the Journal of Portfolio Management. He has a background in data and spatial analytics and uses these tools to provide data-driven research for both clients and the wider market. Andrew, welcome, and we're happy to have you.
Thanks for having me, Gary.
Why don't you tell us a little bit more about yourself?
Sure. So CoStar, of course, is a data aggregator for the commercial real estate market. And the advisory services team is built on top of that. So we have access to the full suite of CoStar data. So we're able to pull together some pretty interesting statistics on the overall market and individual metros on where we see things going. And obviously right now that's become increasingly crucial as real-time data is pretty thin on the ground so far as commercial real estate goes. So everyone's kind of scrambling to get that together, and I've got a few pieces in here today that I think are going to be useful.
Yeah, I'm looking forward to it. So let me switch to that. I guess I stopped share here, and then let me pull the other slide up. Okay, here, and let me share my screen. All right, can you see this new slide? Your slide?
Yep.
Great, so take it away, Andrew.
Sure, so just at the top, in general, multifamily tends to hold up a little bit better through recessions and downturns than other metro or other property types. We largely expect that to be the case again this time around. Multifamily offers flexibility, lower barrier to entry, and generally cheaper pricing than home ownership. And for the most part, households do need a place to live, and multifamily provides that, particularly in a time of uncertainty. Unfortunately, this particular downturn looks like it's going to affect renters a little bit more than usual. So our left-hand chart here looks at the share of renter-occupied units by income versus owner-occupied by income. And what you'll notice is that the blue bars, the renter-occupied, has a decided leftward shift. So not only are renters more likely to fall in that less than $50,000 per year bucket, but they are that's the most likely bucket for them to fall into. About 55% of renter households fall in that bucket. As we relate this to the job market and what we see happening there, in the right-hand chart, you can see that leisure and hospitality is at the bottom of the pack in terms of median income as measured in 2018. And this is particularly concerning because leisure and hospitality has taken the hardest hit in terms of the super sectors through the first jobs report of this downturn, the March report. We expect that to be the case in April as well. So over half of job losses for the March report came in food and drink accommodations, basically restaurants and bars, with a pretty heavy hit in accommodations as well. So your hospitality sector, your hotels. We do expect that to not only affect multifamily to an outsized degree, but especially affect Class C apartments. Um, we have a survey that went through Kingsley Associates in conjunction with our partners, our colleagues at apartments.com, that went through about 25,000 renter households and found that in general the lowest income households were the hardest hit right now. So that's about what we expected. We do think, though, that federal aid will help keep things in line to some degree. Unemployment insurance has been bolstered. Certainly, people have started getting their stimulus checks, and the Payment Protection Act or Payment Protection Plan, for whatever it's worth, has been helping some businesses, though granted not every business that was intended. And that is probably going to help keep a lot of these households afloat through the short term at least. Now, as we look to the next slide, we can see that a lot of the pain has actually not yet been felt by those Class C apartments. So CoStar rates its buildings by star rating. Roughly speaking, we can say that 1 and 2 star equates to Class C here, and 4 and 5 star equates to Class B, or excuse me, equates to Class A. You can see that Class A rents got hit very hard in the outset here. Now, part of this is volatility. Class A rents tend to be a lot more volatile than their counterparts in B or C, particularly as it pertains to seasonality. So in some respect, what you're seeing here is more volatile rents reacting faster. But there is also the factor of unstabilized units to take into account. 20Q1 was an unusually large delivery quarter for the multifamily sector, and 20Q4 or 19Q4 was actually fairly large as well. So we did see the unstabilized vacancy rate spike in 20Q1, including by pretty large amounts in some metros, over 20% in places like Cincinnati and Stamford and New Orleans. And those are not exactly multifamily hotspots, but it is still worth noting that that unstabilized vacancy rate has gone up at a national level. When we look at this, when we look at those rent losses on a metro by metro basis in the next slide, I think you'll see some things that you might expect. So we looked at this in relation to the share of employment in exposed industries. So Las Vegas and Orlando are obviously these huge tourism markets, and you can see them on the left-hand side here. Houston and Denver are energy markets, both of which were pretty negatively affected on this chart. So the x-axis here is 4 and 5 star rent change since March 11th, and March 11th is about when rents peaked for the nation. And in general, the higher the share of employment in these exposed industries, the bigger rent losses we've seen. Now, it's not the only factor at play here. There's also, you have to consider the displacement of workers from a political perspective, which is to say, when did restrictions go into place and how strict are those restrictions? Certainly in some places, for instance, New Orleans, restrictions were notably weak. But certainly the share of employment in exposed industries seems to be playing a big role in what metros are getting hit hardest first. Lastly, we did want to touch on what's going on in the transaction world, how volumes are reacting. So on the left hand chart here, we can see our raw measure of multifamily transaction totals as for 2017, 2018, and 2019. And you can see that in March, 2019 is off a bit, and or sorry, 2020 is off a bit, and in April it's off by a lot. But of course, that doesn't really tell the whole story. It's April 27th, and it takes us some time to capture these data points. So the right-hand chart is really a better explanation or visual of what we're actually capturing for transactions. So this is constrained by, all right, what did we have captured by April 27th or 26th, as the case may be, in March of 2017, in March of 2018, et cetera. You can see that there's still something of a March is still slightly off pace, but April really appears to be where things are slowing down quite a lot. We do expect this in times of uncertainty. Pricing gets confused, and what's going on right now is that there is not a lot of price transparency or price discovery, and we do think that the market wants to buy, but people would like to buy at post-COVID pricing, which is a problem because nobody knows what post-COVID pricing is. That is about so just to kind of sum up, we are seeing rents get hit. We do expect quite a lot of churn in the Class C market, but downward pressure we do expect to save that section of the market to some degree, and we do expect a little bit of a migration reset here. So heavy growth metros that were dependent on relocations or tourism or energy are probably going to slow a good bit in the near term, though of course that may not last forever.
You mentioned post-COVID pricing, and that's really accurate because we've been seeing deals or opportunities, and we're like, well, there's no discount really, so there's a softening of terms where we're not having to put hard money down. You could probably put a financing contingency, but you're not seeing 10-20% off. Now some of my friends in the multifamily industry that have been closing deals during this time, they're seeing some benefit from the seller giving 5% off, not so much 10% off, but the sellers that want to close deals are working with them. But for right now, the deals coming on the market haven't been priced accordingly.
Yeah, well, for a seller who's in a strong position and feels like they can ride this out, I would think they would be hesitating to put a property on the market right now. What we saw in the last downturn was a real thinning of the transaction herd, so to speak, and what we ended up with was a cap rate that got raised up, got pushed up, but we don't think that was a true market rate cap rate. That was reflective of the percentage of distressed sales that went through. So really, I think that a lot of the deals that go through right now are going to have some hair on them in some way, and that's going to appear to push up cap rates. But the reality is that a seller in a strong position probably doesn't have a lot of reason to sell right now, because they are going to be dealing with a situation where if a buyer is looking at this realistically, they're underwriting lower rent growth for the future, which is going to impact their IRRs. So they'll expect a higher cap rate going in, and a lot of sellers didn't underwrite that in the first place, and they're probably going to want to hold through this.
Yeah, we actually, before COVID hit, Kyle and I put an apartment building that we had on the market because it's been performing so well. And actually, April was our best month to date. So yeah, we're not giving any discount, and certainly we want a premium. So that might be something that we take off the market, but right now our broker wants to keep it on the market. So we are looking for deals, yet we're not selling something at a deal.
Yeah, I think that's I think that's generally the consensus in the marketplace is that people are, unless you are time constrained in some way, people are not really willing to give you that discount just yet. One way that you might be time constrained would be financing, of course. So in this, let's say someone has a balloon payment coming up. Financing is going to be difficult to get right now to refinance that building for the same reasons. Lenders are obviously very risk averse, and they're going to struggle to underwrite financing as well right now. So buildings like that could come to market. Uh, the other instance that has actually been delayed would be 1031s. We would expect the share of 1031s sold in the near term to increase, but there's actually been legislation that has allowed 1031s to be delayed by, I believe, 6 months. So that does thin the seller pool even more.
Let's talk about some of the markets that you do like.
Sure. Yeah. So going into a downturn like this, what tends to happen is that growth mediates a lot. So the last downturn we had places like Vegas and Orlando, Phoenix, even Palm Beach, uh, racing out ahead of the rest of the country and attracting a lot of in-migration. As the recession came into play and the job market turned, um, you actually had in-migration return to places like New York and San Francisco and Los Angeles, where it's typically absent. Those places are very expensive, of course. They tend to grow through international migration rather than domestic migration. And so those markets do tend to see an outflow of people uh, when the economy is going well. And that's what we saw these past few years. Um, as the economy contracts and a lot of jobs that uh, would be in industries that are very reliant on dispensary spending, and that includes tourism, um, arts and entertainment, uh, to some degree energy, though certainly not as much. Um, those metros, we do expect to see contraction in terms of their in-migration. So in some respects, despite the fact that, of course, New York is very dense and has been the epicenter of this COVID-19 outbreak in the U.S., we do expect it to actually see a little bit of benefit from this because it is a job center. It's still a job center. So for someone who needs a job, that is going to be a factor that plays into this. When we look at apartments.com, so CoStar apartment listing platform, apartments.com, tracks searches in and out of metros. And when we look at that data, we see that a lot of tech markets seem to be benefiting from this, where while those markets that I mentioned that are tourism and energy and actually manufacturing dependent have all suffered. So searchers do seem to already be uh, um, responding to this potential decline in the job market in some of those faster growth metros.
And so, what kind of recovery? I know it's impossible to gauge that, but what are you looking for? 6, 12 month, 18 month. What are you forecasting?
So I think we can safely rule out V-shaped. I think that there are some people still holding out hope for that, but that's generally been ruled out by most economists, including our own team. Um, We do expect there to be something of a V bounce back, though. Uh, so when we think about the unemployment rate, right now the unemployment rate that you might calculate off of these unemployed statistics, these job loss numbers, might be in the mid-teens to low 20s, even if you were very pessimistic. Um, and that could be somewhere in that range is likely where we'll see April. But 6 months from now, we expect that number to come in a good amount. But that's not to say that it'll recover. Right now, we're thinking somewhere in the 8 to 10% unemployment range for um, about 6 months from now, and that's still a very bad number. That's not a number that you associate with a fast-growing economy. Um, from there out, the recovery starts to slow down, and it probably starts to look a little bit like the last recovery, which was a good bit slower than some of the previous ones. And a lot of that's a function of demographics. The country is a lot older than it used to be, and we're dealing with a working age population that's growing pretty slowly. We anticipate the participation rate to drop a good bit, particularly for 65 plus. The participation rate for 65 plus workers was at an all-time high 2 months ago. That's already declined, and
Oop, did we lose you there, Andrew? Andrew? I think we lost him there for a second. While he comes back, I want to apologize. Kyle actually is under the weather, so he couldn't join us. But let's see some questions you guys have. You could put it in the Q&A, please. No questions so far, huh?
hey, Gary, can you still hear me?
Yep, we got you back now.
Okay.
All right.
Sorry, I'm not quite sure where I cut out there, but I guess just quick overview of what I was just talking about. We do expect um, a pretty sharp recovery from the absolute dregs of this over the next 6 months, but following that, there's probably a much longer recovery back to full employment and back to where we are or were 3 months ago.
And what are the key data points that you guys are monitoring?
Well, right now things are still pretty slow in terms of what's come out from a data perspective. But of course, probably the number one thing we're monitoring is the um, job claims or unemployment claims, not just at a national level, but at a state by state level. Um, those numbers are pretty scary. Over 25 million of those claims have been made in the past month. But it is worth noting that not all of those are going to be full unemployment. People can claim that unemployment benefit when they're underemployed. So someone who could be working at 40% of their previous hours is still going to claim those benefits. For that to for that to be the case is still a good sign, as those jobs haven't necessarily disappeared. Although certainly any any situation where we have 25 million job claims in a month or unemployment claims in a month is not something that we want to be in. The other, of course, the other one of the other main things that we're keeping an eye on or that we're looking forward to is the jobs report that'll come out on March 8th, or sorry, May 8th, I believe, uh, which will break down by sector which jobs are getting hit. And of course, we looked at that for the March report, and that those numbers were very scary for retail and for as I mentioned, restaurants, accommodations. but we think that there's going to be a much bigger hit this time. Well, there will certainly be a much bigger hit this time around, and it'll give us a little more insight into um, what sectors are getting hit the hardest.
Okay, so obviously unemployment, the job reports, any other data points a potential investor or syndicator should be looking at?
Well, if we're talking about economic, we are beholden to what is available through these reports. When we're talking about multifamily or the other property types, we're keeping an eye on our daily rent series that we produce. Um, I would also say that the retail sales reports are a good indicator of what the consumer is doing and what the consumer is feeling. We had a pretty serious drop of 6% in retail spending for the month of March, and that those numbers will probably not improve tremendously. And this falls into which sectors are getting hit hardest. But certainly the price of oil is something to keep an eye on, particularly if you have any investments in Houston, which is obviously the biggest energy market in the US and is struggling through effectively two crises right now between the oil market collapsing and COVID-19.
Yeah, we are. So we have some questions here from Ryan. For those tech markets that show strong apartment searches, do you expect a big change in the cap rates? And if so, by how many bips or a percentage?
So generally speaking, we don't expect a huge change in cap rates through this downturn. As I said, distressed assets are going to push up basically the measurable cap rate, transaction measured cap rate. But if we were to back those distressed assets out, we don't expect a huge cap rate change. Um, Austin, so some of those markets would include Austin or Raleigh. The Bay Area still, of course, qualifies. Um, those markets are already pretty well priced, and there's, as I mentioned earlier, there is an expectation of uh, rent a revised rent forecast that calls for weaker rents. I would say that as you're underwriting those deals, the expectation should be for slightly higher going in caps if you're expecting lower lower rent growth through the next couple years, which you probably should be.
Yeah, I agree. I just don't see, when you take out the distressed assets, the stabilized assets are not going to change dramatically in cap rates. We have so much money available for these assets, particularly from, foreign investors as well. It's just still one of the best places to put your money. So it's just not going to change much.
Yeah.
Um, you mentioned San Francisco, Austin, and Raleigh that they're well priced. Now, does that mean you think they're priced right and there's good opportunity there, or what did you mean by that?
What I meant was that they are richly priced. The it's hard to say when there's an absolute top of the market, but those markets were probably fully priced going into this.
Right. All right, we have another question from Luke. How far do you see each cap rates increase? Oh yeah, so basically same question as before. Not much change in stabilized assets, but this distressed assets, we'll definitely see some good movement.
Yeah, and it might be helpful if I kind of expand on our long-term view on cap rates. So this goes back to our demographic view on the U.S. I mentioned the working age population growth is declining and expected to go negative at some point. Um, by and large, we do consider demographics to be destiny. And we think that plays into why GDP forecasts have generally been lower over the past, let's say, 5 or 7 years versus 20 years ago or 30 years ago when we had a much bigger population growth or much higher population growth. Um, as that population growth decreases and as those demographics get worse, we expect GDP growth to follow. The 10-year tends to follow that, and then those spreads on cap rates tend to follow as well. So over the long term, we do expect that lower, longer viewpoint that's become very popular. And I think for evidence to reflect that, you look at, all right, what are the countries that have kind of beaten us to it? Japan, of course, is the obvious, like, shining example of what happens as a nation ages and the population slows. But certainly places like Italy and other parts of Western Europe are reflective of that as well. The one caveat there is that America has had pretty strong international migration. Were that to keep up or increase, or I should say, were that to increase, it kind of rescues us a little bit, but that doesn't seem to be the way the wind is blowing.
All right, and we have another question from Ryan. Do you anticipate liquidity issues in the lending markets and where there will be limited lending available?
Yeah, well, I mean, we already got there, and we've walked it back a little bit. The Fed has managed to walk it back a little bit. The CMBS markets froze up for a while, and they've been able to walk that back to some degree. Multifamily, in particular, of course, is backstopped by Freddie and Fannie, which gives it a little more flexibility. But in general, yes, lenders are going to be more circumspect in handing out cash. In a not directly related example, I know that a number of banks have tightened up lending standards for single family purchasers, and that's the case in pretty much all lending markets at this point.
We have a question here from David. Do you have any thoughts on availability of refinancing through agency debt over the next several months?
So I will say that that's not necessarily my area of expertise. We have a debt team at CoStar, the CoStar Risk Analytics team that would be able to speak to that a little bit better. The agencies, of course, are federally mandated to make these loans. I do think that they're going to do their best to get that money out the door as best they can.
All right. Any other questions? All right, well, see if any other pop up, but here's our contact information. If anyone wants to reach out, please join our Facebook group, Passive Income Through Multifamily Real Estate. And if anyone has any other questions, I guess that is it. Well, Andrew, thanks again for for joining us tonight and sharing your expertise. I learned a lot, and I'm sure everyone that participated learned a lot as well. I know I've got a bunch of people that reached out and couldn't join us tonight, and we'll share this on our YouTube channel because there's a lot of competing webinars out there tonight, so I can't always attend all of them. But I again appreciate you joining us, and I'd love to have you back on in the near future.
Thanks a lot, Gary. And sorry about the audio coming in and out.
No worries. All right. Good night, everyone. Thanks for joining us. Bye-bye.